Okay, so CMHC stands for the Canadian Mortgage Housing Corporation. So it's a default insurance that you have to get on your mortgage. If the lender says you have to get it, one, or if you put down less than 20%. So you don't always have to get it, okay? And then they also, on top of that, have their own requirements on top of what the lender would have when they give you a mortgage. Okay, so keep that in mind. So CMHC changed how they were going to be lending out their default insurance. And the default insurance is not to protect you as the mortgage owner, but to protect the lender. That's right. So effective March 17, what they did was they actually increased the rates that they were charging to people for the mortgage that you take. So this is what it was before March 17. Okay, so if you, let's say, were only putting 5% down, you would actually be having to pay an extra 3.85% on top of your mortgage. But let's say you were putting almost up to 20% down, then you'd be paying 1.25. So that's why a lot of people put 20% or more, because then they don't have to get CMHC insurance. Okay, so what happened is effective March 17, they increased the rates from there to these ones in orange. So you can see if you were just putting 5% down, you, instead of paying 3.85, you'd be paying 4.5. Yeah. Okay. And then if you're porting your mortgage, which is a different type of thing, the rates are different there. So we're not really going to talk about that today. It's more just on the primary loan. So for a first-time home buyer, or if you're buying an investment property, right, and you're able to get away with less than 20%, then these are the percentages, the new percentages you would have to deal with. Okay, so what does it mean? Okay, so if you were to buy a house for $850,000, your monthly amount would go up by $30. So in the whole big scheme of things, you think, okay, my monthly payment is just going to go up by $30, not a big deal. Yeah. But if you look at it over a 25-year period, it's $166,000 on top of the price of the house. That's right.
The original interest.
Yes, on top of the original interest that you would be paying. Yeah.
That's almost like a house in some places.
Yes, that is right. That's right. So that's what that is. So this came into effect March 17. There isn't anything else planned for the rest of this year, but they could potentially make another change down the road.
And they obviously wouldn't be sending it down.
It would be going up. Yeah.
So why are they? Are they just thinking they're not making enough money and they're just doing a revision of pricing across, their products, or like is there a specific?
No, it's not so much them not making the money. It's the so for example, like in the Toronto market where the housing prices is so inflated, right? And so even though the default rate in Toronto is very, very little, in other parts of the country, the default rate is a little bit higher, right? So the percentage is going up because one, if somebody defaults on their mortgage, then this protects the lender, right? And there is a concern right now about the default rates going up, because if the interest rate on your mortgage goes up, it's been shown that there's a significant number of people or a significant number of families living paycheck to paycheck, right? And so there is a concern by the government and from the lenders that people are not going to be able to make their mortgage payments. Well, which is why they've required the banks to do the stress tests, right? And which is why they're now saying that we have to qualify people at 4.64, regardless of them being able to get a mortgage at 2.5 or 2.6%, right?
Because regardless if everything goes south, you're going to end up in the 4% range.
Yes,
so you
exactly.
Need to be able to, in 25 years, at any point, you need to be able to handle that change.
Yeah, absolutely. So the rates are starting to go up. Like last year around October, November timeframe, the rates were around 2.4, 2.5. Now the rates are around 2.6 to 7. The prime rate has also gone up as well. It's now 2.7. Right? So Yeah, so this is in line with the people thinking that the bubble's going to burst. People are not going to have as much equity in their home as they thought, because while the market is high, houses are being appraised at a higher amount, right? And so people have been lending, 65, 75, 85% of the value. And if the housing market price goes down, that equity won't be there anymore. So if you got your mortgage up to 80% of your equity, and then the price of the house goes down, then really your 80% is now at 90 or 95. And there are going to be some people who will walk away from it and saying, it's not worth paying the mortgage, or it's not keeping it anymore, and they'll walk away and default on their mortgage.
Especially if they're not trying to be in the right place for investment properties. It's easier for them to walk away from a property that's not their home.
That's right.
Right? So there'll be a lot of that happening, basically. Because we have a big business in home flippers and subletting.
No,
and stuff
no.
like
So the majority of the default will not come from flippers, because a flipper will do their numbers so that they will account for the market to go down. Okay. And when normally a flipper will flip within 3 to 6 months. Right? Yeah. So the market usually will not jump to the point where a flipper will walk away from a deal. Okay. And normally flippers will have private money to do the flips. Yeah. Okay.
Do you have another plug? Oh,
yeah.
Sorry.
So normally this is for somebody who is doing who are it's their primary home.
Families that are going to suffer now.
Yes. Yeah. Exactly.
Gotcha.
Okay.
So that is extremely bad.
Yeah. Okay. So that is the CMHC change that happened already. So if you are looking at buying a home in the next, I guess until the end of the year, this is the fees. Yeah. This will definitely affect you. Okay. All right.
How, in the grand scheme of things, I mean, I understand. So they're not just doing it to get more money off the policies. They're doing it to essentially add more protection to the market. Or the lenders.
For the lenders, market. Yes, that's right.
How, overall, how do you see this affecting us, 2-3 years down the road? How does it affect everybody else outside of the people who are going to get turfed out of their homes, possibly?
If you are putting more than 20% down, it won't affect you. Yeah. The only thing is that at some point, if the regulations change, saying regardless of how much you put down, you have to get default insurance.
And that's where I'm thinking it looks like they might be going that way.
Yeah, the lenders might require you to do that.
So that's the biggest.
Yeah, which will then make it more harder for people to.
To get a house.
Yes, and for people who are investing, it will definitely add another layer of difficulty in getting the funding.
It'll deter a lot of non-serious people.
Yeah, that's right. Absolutely.
Which is good. I mean, kind of good. It's good and bad. At the same time.
Yeah, absolutely. Okay.